Hi, Paul here with the Money Trend. You may recall from the last video we were looking at moving averages, and specifically we were looking at the moving average of closing prices versus the moving average of opening prices. Now if you haven't seen that video, then probably best to go back and review that, but I'll just recap very quickly that here we're looking at, in green, the moving average of closing prices. This is for a 7 period, and also a 7 period moving average of opening prices, and we can see that this really tells us quite well when the market is trending up or down for a given time frame. Now this works on any time frame. You can put this on I wouldn't advise going to tick charts or really sort of 1 minute or 5 minute charts. I don't trade those. I certainly wouldn't use moving averages to trade those, but you know, certainly from the 1 hour upwards, they can be quite useful. Now, one of the problems with any moving average is it is a lagging indicator, and this is no different. It tends to lag a little less, but of course, being a moving average, it is still a lagging indicator. And there are times when no trend develops, and the advantage of this, we do get in quite early. So where we have no trend here, the market's pretty much going sideways, whereas we would normally be whipsawed out of these for a small loss. In this case, we're probably going to make a tiny profit or come out flat. So we're not going to be losing money. And at the end of the day, in trading, that is the main thing. If we can avoid losing money, then on our profitable trades, we're going to be miles ahead of the game. That really is the key, is keeping your losses to a minimum. I know you'll have heard this time and time again, but you can't overstress how important this is. If you keep your losses to a minimum, it keeps you in the game, and that is what separates the winners from the losers. It really is. It's more about that and risk control than it is about predicting. Nobody can really predict where the market's going to go. We don't have a crystal ball. All we can do is control our loss. Our risk is controllable. It's ultimately up to us, but our winnings are not controllable. The market will only give us what the market will give us. So you can only control what you can control, and risk you certainly can. So there's no excuse for not making sure you've dotted all the I's and crossed all the T's on this one. So here in this example, we've got the market going essentially sideways, and here we're able to get in and out of this market quickly enough that we're not going to get we're not going to come out too badly off. We're actually going to make maybe a marginal profit or just come out flat. So what can we add? In an ideal world, we'd probably want to just keep out of these trades. So what can we add that may keep us out of some of these margin or losing trades? And I like to use ATR, so that's average true range, which is a measure of volatility. So we'll use a 7 period as well in this case to change that to 7. Let's give it, what color? We'll leave it at blue, but I'll make this just a little bit thicker so we can really see what's going on. Okay, so there's our average true range. So what the average true range is really essentially measuring is the difference between the average of high prices and the average of low prices. So it's measuring the range of prices from low to high. And when that range is small, so when the difference between the average of low prices and the average of high prices is small, that's an indication that volatility is low. When the gap between the two widens, that's an indication that volatility is high. There are lots of things you can use to measure volatility, but I like this one because of its simplicity and that it's connected to price directly. I like to use indicators, if I'm going to use them at all, that are directly related to price, because indicators that derive from price but are too far removed from it are going to be more lagging and tend to be less robust. We talked about robustness on the last video. I'm a great big fan of using robust indicators to give me my sort of heads up on what's happening in the market. So here we can see, let's take you through each one of these potential entry signals here. So here the 7 period of closing prices crossed the 7 period of opening prices, but volatility was quite high already, because we've had these big moves, I probably wouldn't be looking to get into the market here. I don't like entering the market when volatility is high because typically periods of high volatility are then followed by periods of low volatility. Now in this case, that wasn't strictly true. I mean, it did fall, but we still saw some good moves here. But very often after periods of high volatility, we just go into really flat periods and there's no money to be made. So we want to anticipate when the market might be setting up for one of those periods where we're going to have some wide bar expansion. And during periods of low volatility, typically the market is setting up for another period of high volatility. It's one of the few things that we know is predictable in the market, that high volatility is followed by low volatility is followed by high volatility, and so the cycle goes on and on and on. We can't predict the timing between those cycles. That's something that, certainly I've never found any way that you can do that. But what we do know is that we're probably best not entering the market when the volatility is high, because we're entering at the highest point of risk with the lowest potential reward. What we want to be doing is the opposite, which is getting into the market during a period of low volatility and then hoping that volatility will explode and that we can ride that wave and then get out. Now, why would we want to enter the market during periods of low volatility versus periods of high volatility? Well, one of the reasons is that when the market's going through a low volatility stage or phase, we can usually quite quickly know if we're wrong and get out quickly. When bars are expanding, like here, for example, or here, let's take this example. We've got wide expansion here. Now, if I entered here on this bar, I'm going to have to put my stop somewhere up here, away from the noise of the market. Otherwise, it's meaningless. So I'm risking a heck of a lot on that move if I'm wrong. Whereas if I perhaps entered the market here during this period of low volatility, I might put my stop just up here. So I'm going to know much sooner if I'm wrong, because the bars are going through, all these bars are contracting and they're going through a period of low volatility. So during those periods of low volatility, the risk is lower and the potential reward is higher. Now, yes, we'll miss out on some good trades, like potentially here, we may have missed out on a good trade, but I'll do that every day. I mean, I would be happy to miss out on some good trades if it keeps me out of a lot more bad ones. So we can see here volatility is very low. So this is a move that we could have got into here and we could have made some good money there. There was a fair bit to be made there. The market swung down here, and again volatility was fairly low. It's quite hard to interpret sometimes because there aren't any set numbers with the ATR. You've just got to look at what has been historically high or low. So here it's kind of mid, but I'm okay with that. The only times I really don't want to be trading are when the volatility is peaking. But otherwise, if it's average to low, I'm happy with that. I'm okay to enter the market during those periods because it's relatively low risk. So here's an example. Here's one of these trades, which if we'd taken, we would have just perhaps made a tiny amount, or we would have lost a tiny amount or come out flat. On the entry to this trade, volatility is quite high. It's peaking here. So I wouldn't have been interested in taking this. There's already been some bar expansion. No, thank you. I'm not interested in getting into that move. Same with this one on the way down. I'm not interested because volatility is just still too high. This one here, volatility is falling. We've got a peak here and we've got a lower peak here. I quite probably would have got in to this move. Would have made a little bit. It's not a fantastic move, but I probably would have traded this one. This one, no. Volatility rising. This move here, probably not. It's still a little bit too high for me relative to where it's been recently. This move here, now this is quite a good move. Would I have taken that? Maybe. That would have been a marginal one for me because volatility is falling and This peak is about the same, so yeah, I don't know on that one. That would have been a close call. But you get the general idea that it does keep us out of some pretty potentially bad trades. Now here's an example where it would have kept us out of what may have been a reasonably decent trade. We could have potentially entered the market somewhere here, but volatility is just too high for me. I just wouldn't have gone into that market. And it's very choppy. I mean, this could go either way. When the bars are flying like this, they're already, I mean, we've got a very wide expansion bar here. Great if you caught it at the beginning of the move, but I wouldn't have been a happy bunny if I'd gone in up here. So during these periods of high volatility, personally, I just keep away. Here, we've got an entry into the market just here. Volatility is much, much lower. I'd be perfectly happy to get in here. I wouldn't have any hesitation entering the market there. This one here, now this is a trade we probably would have come out flat. I would have taken this one, and it ended up not being a great trade. You're going to get those. It happens. You can't win every trade. You're never going to win every trade. It's always, probably one of the first things that you're going to have to learn in this game is to accept the losses. If you can't do that and move on, if that weighs too heavily on you, taking those losses, then perhaps this isn't going to be the game for you, because you do have to adjust your mindset to that. So that's this trade here. Yeah, possibly wouldn't have taken that one. And then this end, there's another signal. We don't know where this is going. This is live data. So as I'm recording this is live. So I don't know how this is going to unfold. But would I have got into this move? Yeah, quite probably. Quite probably I would. So I would probably have an open trade at this point. If I were trading this pair, I would have an open trade at this point. So hopefully this has given you, all these indicators are readily available in any package. I mean, I'm using MetaTrader here, which if you trade currencies or commodities or the indices, this is a great software to use because it's free. Anyone can get this live data for free. So that's one of those examples of where you can actually have a free lunch. But this is the only platform I know of where you can get free live data. And these indicators, I mean, this is just a moving average, so these are readily available free. This indicator is just the average true range, so again, readily available free. So I hope that you found this useful. And this helps you again to establish some of the building blocks that you can use to move forward and get yourself a productive and a profitable trading system. Thanks for watching.